because 3, 4, 5 years from now, when you look at your results in venture capital, my feeling is it will be either the best performing or among the best performing assets. So that's what changed. My favorite joke is in FFF, everybody thinks that they're the first two Fs, but everybody is the third F. So we all think we're either friends or family, but we're mostly fools. Invest only in companies with millions of dollars in sales. If it's tens of millions, it's even better. Oh, sales are doing fine. Don't worry. But you haven't sent the numbers for a few months. Oh, because everything is fine. Send the numbers. You don't need the numbers. Yes, I do.
Hello, my name is Ulyana. I am CEO and founder of Quorum. Today we are on our podcast hosting the wonderful speaker and venture capitalist, Igor Shoifot. And welcome to the podcast, Igor.
My pleasure.
I would like to give you actually the floor to introduce yourself.
Hi, everybody. Ulyana, thank you so much for having me over, for introducing myself. Igor Shoifot, indeed. I live in San Francisco. As you see behind me, it's a little bit foggy but sunny, which is typical for the fall. I was born in Siberia. My parents were born in Ukraine. I very much support Ukraine, and so I'm part of one of the three co-founders of Ukrainian syndicate called Toloka, which actually uses Ulyana's wonderful solution, Quorum. And we really, really like it. Gathered over 1,000 now Ukrainian investors, 2/3 of whom, by the way, live in Ukraine. And we invested in exactly 1 year since founding in 11 startups, $12.5 million. I'm also an experienced venture capitalist of at least 15 years. I've been a partner at a London Stock Exchange traded TMT investments. We made over 100 investments, had 23 profitable exits, including several unicorns where we were the first investors. I'm a prolific angel investor. I started in New York City back in the 1990s. I lived in the US for 30 years. And I was founder and CEO and COO of and co-founder of a bunch of startups back in the 90s. I was the CEO of a gaming company in New York City called Epsilon Games that wrote more than 70 games. Then I co-founded a photo sharing company also in New York called Fotki, which grew to 25 million users. And then in 2004, I also sold a startup that I single founded called The Internship in New York, which was a portal for almost 1 million graduate students, MBAs, JDs, MDs, PhDs, looking for internship. And last but not least, it's a very long list. I also taught at UC Berkeley and New York University for 11 years.
It's super impressive. I know your story a bit, but every time you tell it, it inspires me a lot. And thanks, of course, so much for supporting Ukraine. I'm very privileged and honored to work with Toloka.vc and with your team to support the syndication and all wonderful Ukrainian investors who actually invest in the scale-ups, in startups, and put their piece into the innovation, into driving the innovations. So I actually want to ask you about what currently the environment for venture capital. How do you feel 24 is treating venture capitalists and startups?
The short answer, thank you, it's probably one of the most important questions right now. The short answer is the closer you are to San Francisco, where I am, in Silicon Valley, the more active investments are, the more positive everybody is. As you move a little bit to New York and Boston and Texas, it's not as rosy, although still there are a lot of investments. As you move to Europe, there are fewer investments, and as you move in Europe from the West, from the UK, Netherlands, and other more active countries to less active countries, in some cases it's much, much less active. However, there are a lot of wonderful exceptions. A country where I co-founded a startup, Estonia, which is a really small country of just over 1 million people, has a tremendous number of startups, a lot of unicorns. We were lucky at TMT to invest very early as the first venture investors into two Estonian companies that became unicorns, Pipedrive and Bolt. I would say in general, the mode here is not as great as it was just 2 or 3 years ago because of the wars, instability, a whole bunch of other issues, lack of successful IPOs. A lot of companies are bleeding cash. A lot of companies are unsure as to their future. There is a lot of skepticism, et cetera, et cetera. But investments are still continuing. So it depends on the matter of perspective. If you compare Silicon Valley and San Francisco to the rest of the world, wow, it's crazy. Every day there are dozens, maybe even hundreds of investments. If you compare itself, San Francisco, to what it was just in 2021, oh my god, it's like several times down. It was just absolutely crazy, and right now it's just crazy, but it still continues. And even if you live somewhere, for example in Germany or in Poland or in Belgium, there are still many very active angel investors, venture capitalists. It just changed very much, but I think startup and venture capital industry is here to stay. And I frankly think that a year or two from now, it's going to be much more active.
It's great news for us, for you, and definitely for all investors in the startups and for startups itself, because we definitely need more investments into innovations, considering
Yep.
all of the challenges that we see around the world. So it's good that we seeing this trend or expecting the change. So talking about trends, what kind of the trends, global trends, or probably the regional trends that you see that will impact the investment strategies, right?
Sure. It's another very important question for everybody to think about. Well, several obvious things, very obvious. There is AI revolution going on, and a lot of things are being replaced by so-called artificial intelligence. A lot of things. Almost every day I'm using AI when I'm taking taxi because I'm using Waymo by Google, which is a driverless car. Every day, I think most of us, probably you, Ulyana, and myself, are using ChatGPT and a whole bunch of other AI tools, and it's becoming absolutely normal. It used to be, wow, like I used to be getting into this car. I've been using it for a year and a half without a driver, thinking, oh my God. And right now, I still sort of a little bit feel like, wow, this is so cool. But I don't feel like, oh my God, it's so cool. I just feel like, oh, it's so cool. I'm in a car with no driver. I think, first of all, what's changing is the technologies are changing, and AI is, as they say, eating up the world. Secondly, what's changing, there are several other amazing industries, space, medical services, and several others that are going through revolutions. Medical services, because medicine, especially in the US, not probably in Great Britain too, not so much in Europe, because in the US there was never really a well-built system of the state medicine. It was always very private. And so everything is very outdated and exists as this big archipelago of very, very ancient ways of servicing patients, registering, getting doctor advice, nurse advice, et cetera, et cetera. So this revolution is happening, and it's really amazing. Lots of really, really interesting things are happening in other technologies. What's happening in space is also incredible, because not like technologies are changing that much, but even just 2 years ago, all the space startups were just pure tech. We have this great technology for reading the map. We have this great technology for navigation. And okay, great technology. But these days, you talk to space startups, and they say, we have $30 million in revenues. We have $40 million in revenues. We have great growth. We're selling to NASA, to European Space Agency, to Japanese Space Agency. So commercialization came, and these companies are starting to make money, to make profits very often. And that's really amazing. And I think you will see in the next few years how AI medicine space will be exploding. The second thing, and it's very much related to you and me, Ulyana, is that investment became democratized. It used to be that even here in Silicon Valley, in San Francisco, it used to be that you could be an investor only if you're either really rich. And in that case, you could put, a couple of $1 million in one fund, another $1 million in another fund. You could meet somebody at a very upper class party, and they would say, hey, a friend of mine knows the startup Google. They're looking for money. The minimal check is 5 million, and you would put this money. But nobody was ever interested in unknown people with their 10,000, 20,000, or even $30,000, $50,000. You had to have connections. You have to know the people. And usually, again, the checks had to be, well, at least 100,000, 200,000, maybe half a million. And these days, it's very different because of companies like Quorum. You could invest literally several $1,000s, literally without knowing any, big names, without participating in any big parties, and you could become a part of investment. And the reason to do this, as Ulyana would tell you probably better than I do because it's her business, is because this market, the startup, the venture capital market, outperforms other markets. So if you have a certain amount of money, if you are, and obviously your audience are smart people, if you're thinking about where you will be in 5 years and 10 years, etc., the effective planning is, of course, not to put all your money in venture capital. It's ridiculous because it's risky and it takes time. But to think, and for example, if you feel that you have extra 50,000 or 100,000, 20,000, 200,000 every year that you need to put somewhere, then you put some of this in T-bills, you put some of this in crypto, you put some of this in stock, but you put some of this in venture capital. And it's a very smart investment because 3, 4, 5 years from now, when you look at your results in venture capital, my feeling is it will be either the best performing or among the best performing assets. So that's what changed.
Wow, it's a great overview of the trends, but it's also, you actually answered my question. The next question about why to invest in startups, right? And so now I hope the audience can understand it really better that this asset class indeed overperformed, but still diversification would be the key in building your efficient portfolio. The good news for us is definitely that it democratized, and we see ourselves as Quorum actually on a mission to facilitate collective capital allocation, right? And give the access for the angel investors to participate in scaling companies, in startups. One thing which I probably want you to explain to me or share, because a lot of the syndicates actually are mostly to be considered investing in startups in early stage, pre-seed, seed, at best Series A. And with Toloka, I learned that actually the syndicate investing could be totally different, not like everyone expected to be. Can you tell a little bit more about Toloka's thesis, right? And what you do?
Thank you, Lama. Actually, when you tell people that you're an angel investor, most of the people feel exactly like this, that you are investing in very early stage, that you are investing in sort of idea stage or minimal viable product stage. So when the product is just starting to work. This used to be the case. And it used to be that all that angels were investing were early stage companies. But there were many reasons why, and there are many reasons why this changed. So first of all, angels could not invest just several years ago, angels could not invest in late stage companies unless, as I just mentioned, they were really rich and could put $1 million, $2 million, and they had connections. Even if you are a very wealthy person who can afford to invest $1 million, if you don't have connections, you can't invest in very powerful startups. Like you can't invest in scale AI just by calling them and saying, "Hey, I'm going to put $1 million." Like, that's your problem. You're not going to put $1 million. We're not raising from you. Who are you? You're some owner of some stores. We don't care for you. So first of all, people couldn't put money in later stage startups, which is why they didn't. Secondly, the whole economy of raising money, it's very, very expensive to for a startup to deal. So for example, as you know, since you managed Quorum, our typical number of investors would be, let's say, 120 investors. So imagining a startup, and right now I'm advertising Quorum again. So imagining a startup that says, okay, let's deal with 120 investors. So you need to talk with 100 and plus people. Do you even have time to speak with 100 plus people who don't know each other? You don't. You need to check their KYC, AML, sanction lists, et cetera, et cetera. Do you have time to do this? You can, yes, you can hire a lawyer, but it will cost you thousands of dollars. Do you have this money and the time? No, you don't. Do you have the time to deal with these people when they will be asking you questions, sending your emails? You don't. So nobody wants to deal with that. So that's the main reason why in the past, angels could only invest in really, really early stage. Typically, it's called, I think your audience is smart and they know this, but usually in San Francisco, you just say, oh, it's triple F or it's FFF. But that means friends, family, and fools. And there are many jokes about that. And my favorite joke is in FFF, everybody thinks that they're the first two Fs, but everybody is the third F. So we all think we're either friends or family, but we're mostly fools. And my own experiences like this, my first 15 investments were FFF. And looking back, I was the third F. I was a fool. Nice guys. Nobody was lying to me. It was great stuff, but it was just early, super risky stuff. And I was investing, great people, great idea, great market, great tech. Nothing came out of it. I mean, one company sold and it was very little, very, very, very small return. So angels became smarter. And there is a wonderful person whom I happen to know personally. He's not going to be watching this, but Naval Ravikant. He is one of the first investors in Twitter. He made, I don't know, definitely hundreds of millions of dollars. He founded a company called Angel List or Angel.co, which pioneered the whole syndication, the whole idea of several people, hundreds of people, thousands of people, or at least several, 4, 5, 10, getting together and saying, here's my 10,000, here's my 20,000, all together, here's 200,000. Let's see if we know somebody like myself, an experienced VC, who could bring us to a company that we can invest in. And so a person like myself or like Naval Ravikant, who is much more experienced, influential, and successful than I am, says, oh yeah, I know a company and I can introduce you. And so in the past, people like myself would just do it for free. And because we would do it to our friends and we would do a lot of work. We would go to events. We would bring this, we would organize events ourselves. We would connect with other venture capitalists. We would send our deals, our startups to other venture capitalists. We would receive these deals from them. We will have meetings with these companies. We would analyze their data. We will ask them questions. We would do due diligence. We would hire lawyers, attorneys. We would do a lot of stuff. And in the past, we did all of this for free. But Naval had a brilliant idea. He said, listen, you could do it for free to your friends, and they would return the favor and do something to you. But how about strangers? We could also do it for strangers if they pay a small fee. And so that's essentially Quorum's business. You're creating this entities where people who don't even know each other come together, and somebody puts 10,000, somebody 30,000. You make sure that all these people are, as they say here, kosher, that nobody's violating anything, that these are legitimate people, that they go through anti-money laundering and know your customer procedures. And then you gather together a certain amount of money, like $2 million. And you tell groups like ours who brought these people, okay, guys, I'm ready to transact $2 million into this company. Please pay my fees because I also did a whole bunch of work for you. And so the people investing are paying the fees. We're paying the fees. You're sending in transaction. Startup is getting the money. Angels became less part of this question. Angels usually were very smart, but right now, and huge thanks to Naval Ravikant, they became much smarter, and they said, when we invest in early stage startups, first of all, it's very risky. As I would tell you, because I invested in 15 early stage startups 15 years ago, only one survived and was successful and didn't even make me much money. So it's super, super risky. That's number one. Number two, it takes a lot of time. Don't believe startups who tell you, oh, we're just starting 3 years from now, you'll be multimillionaire because we'll be successful. No, typical, and it's very well-known data, typical lifespan of a startup is 7 to 12 years. So we could say 10 years. So when you're investing very early stage startup, if you're 42 years old, on average, until you're 52, nothing's going to happen. You're not going to see any money. So that's the second problem. The third problem, it's very hard to verify anything. There are no numbers. There are no sales. You don't know if there will be a market fit. You don't know if the team will quarrel, the founders, and will split their way. You don't know if the product would even work. You don't know if the customers will pay for it. You don't know if competitors will overpower the startup very, very early and it will go out of business. So it's too risky, it's too early, it takes too much time. And so smarter people like us say, listen, what we can do is we give you access. And this is a very important word here. Actually, in California, there are two greatest cities in California, are Los Angeles and San Francisco. And both are about access. Los Angeles is about access to Hollywood, music, entertainment. San Francisco is about access to technology. And so we give you access to technology. We give you access to companies with $10 million in sales, $100 million, $1 billion with sales. And smarter people invest later because you get your money back faster, because it's much, much more secure, much less risky. The chances that a company with no sales would break apart are very high. The chances that a company with $50 million and fast growing sales will break apart still are there, but are very, very small. So that's why we think later stage investments are important. And you mentioned about Toloka's thesis. Toloka's thesis is, I think, probably, to my mind at least, is the best investment thesis. Invest only in companies with millions of dollars in sales. If it's tens of millions, it's even better. Invest only in companies with proven business model that demonstrate at least 100% growth per year. If it's a really huge company like $100 million, it could be maybe 50, 60% growth per year, but it can be, 5%, 10%, 20%. Invest only in companies with reasonable valuation. So for early stage companies, something like 10 times to annualized revenues. If they do $5 million in revenues, then the typical price would be 50 million. We do this because we want to make money when the company sells itself. Because if you invest at 50 or 100 times annualized revenues, and a company then grows maybe 3 times and sells at 10 times the revenues, obviously you're going to lose your money. And we only invest in companies in regions where we see very high probability for exit. So most importantly, United States, Canada, UK, and European Union.
I see, on every time when you have the deal going through the Quorum platform, how impressive actually the deal flow is. And I know that you are the driving force behind this.
Thank you.
And
Yes.
I know that it's actually definitely not easy for every syndicate to get this kind of the quality. So I can say here that I obviously can cheer for every investor who is investing together with Toloka, because they get access to very exclusive deal flow. On the other hand, what I probably want to, as a founder, want to mention to our audience who consider investing is actually there are definitely the early stage startups, right, which you potentially also can consider to invest, but it probably should be on a very good balance to your portfolio in overall. So definitely don't put all the money into very early stage companies, right? But early stage companies, we also need them to be invested, because this is where the innovations are born, right? And this every scale up once being a startup supported by the angels. So this is like my kind of the founder's input to this. Don't forget to support the innovations on the early stage, but make sure that you balance your portfolio right. What else you can actually recommend to investors to minimize risk when they're investing in startups?
I would say that when you're investing, this would be your second question. The first question is, how will this startup make me money? And second, how do I mitigate risks? Unfortunately, there's no way to assure 100% that there are no risks. Absolutely no way. You can check the technology, you can check the financials, you can look at the market. Nobody can ever guarantee you that the startup will make you money. There are many, many reasons why a startup fails. For early stage, a typical reason, they run out of money. They need to pay salaries, they need to do marketing, and you don't have the money. So you kind of sit down and say, "Hey guys, we have no money." That's it. It's the end. It happens very often. Another main reason is there are problems in the product, and technologically, there was an era back in the 90s when technology was much more complex, where pretty much every startup had to put together their own servers. And I remember doing this myself too. Right now, nobody puts together their hardware. Nobody, everything is in cloud. There is Amazon. There is a whole bunch of other cloud services where you can put all the information. There are wonderful APIs. You don't need to create your own billing system. It's just one click. You use Stripe and stuff like this, and bingo, you got your billing system. So it's much, much easier. So technologically, the risks are much, much smaller than they used to be just 10, 15, or especially 20, 25 years ago. However, competitors are a huge risk. Almost all startups think that their technology is the best, but very often competitors come up with something better. What's even worse is that your technology could be great. You could have amazing, amazing technologies. Almost nobody, except for people who work in database software, almost nobody remembers Oracle competitors. Oracle had a lot of competitors. A lot of their technologies, I'm almost sure somebody listening to you is a specialist in database, maybe not one person. And they do remember how many great database technologies were out there, still are, and how many of them were so much better than Oracle in so many respects. But Oracle won not through technology. Oracle won through amazing business, through amazing selling, through amazing marketing, through incredible PR, through incredible distribution channels, et cetera, et cetera. So Oracle won via business strengths. And that's a huge risk for a startup. And you can't know when you're investing in a startup, especially very early stage startup, what the competitors would bring to the market, or what existing competing companies are going to offer to clients instead of what your startup is offering. Another huge risk, of course, is regulatory risk. Your startup could be doing fine until regulator says, "Oh, sorry, you can't sell medicine online anymore. Closed." And that's the end of your startup. That's selling medicine, for example. Another big risk, and unfortunately I saw it many times, is that founders are lying. They are cooking up their reports. They're sending you numbers, which turns out to be lies. They run out of money, and you figure out that instead of a few $1,000,000 in their account, they have nothing. And that happens, and that happens quite a number of times, unfortunately. So there are a lot of risks. So what do you do? I must have scared a lot of people in the last few minutes. So what do you do? First of all, you realize that it's a risky industry, and so you can't put all your eggs in one basket. It's a very bad idea, even though, frankly, I did it myself several times, and I always regret it looking back. Like, I invested, my typical check is 10, 20,000, but I invest in dozens of startups per year, and I will try to keep to this discipline and to continue this way. But a few times I put large checks, like $100,000. And unfortunately, every time the startup didn't do well. And so the lesson to me is, don't put huge amounts of money. I mean, to me, 100,000 is a lot of money. There are some people to whom it's not. So to me, a typical range is 10, 20,000, as you, Ulyana, know, since you see our investments typically, what we invest. And I like doing that because I'm hedging. as they said, I'm hedging my bets. So hedging is an idea that you don't put everything in one or two things. But for example, to all of investors in Toloka, we're saying, listen, we're probably going to be doing 10 to 12 investments per year. You really don't have to invest in every single one. But our recommendation is, instead of investing into one or two, if you, for example, have 100,000, distribute them evenly and do 10 investments at 10K. If you have 500,000 to invest per year, again, distribute them equally and do 50K in each case. It's better for you. It doesn't matter to us if you put the whole thing into one or the whole thing into another. But believe us, some of the startups that don't seem as exciting would be super successful several years from now. And some of the startups that seem amazing might be, well, kind of okay, but not super successful. And so you'll be biting your nails and elbows when you would know that there was this startup that we brought to you that made a lot of money, like 30x, 30 times the amount that we invested, and another startup where you put all your money made only 2x. So you should have put, half here and half there, and you would have made on average a lot of money. So the first suggestion is hedging. The second suggestion is, if you don't understand something, don't invest in it. It doesn't matter if Toloka or somebody else is telling you that it's great stuff. If you don't understand what it is, how it works, just don't invest, because there will be a lot of frustration. You would tell yourself, I invested in something that I don't understand, I don't know how to work, etc., etc. The third is, don't trust in anything but numbers, especially sales numbers. Look, most importantly, in every startup, don't look so much into a story. It's great technology. We are doing something amazing. We have a strong team. The market is great. Look into the most important part, revenues. What's happening with sales? Are sales growing or not growing? What's the burn rate? Is the burn huge? Is it dangerous? Does the company have a lot of money and enough money to continue? In some cases, nothing is bad with burn, even with huge burn. If a company showed a history of very easily raising a lot of money, and raises 20 million here, 30 million here, 50 million here, even if they have tremendous burn, like $1 million a month, if they have 5 years of money for this burn, that's really not a problem, for as long as the company is growing fast. So these would be my advices. Again, don't invest in things you don't understand. Hedge, put into a whole bunch of different startups, not into one startup. And very importantly, look into numbers, and especially into revenues, into burn rate, into how much money the company has. This is the way to at least somewhat assure that you would have successful companies. And never invest just because you think, oh, such a great technology, or such great guys, or such great market. This is a path to nowhere. Try to have some discipline and tell yourself, listen, I can only believe in numbers. I cannot believe in everything else.
Definitely agree with you with all points, and it's interesting what you mentioned, really about the that actually the startups that you expected to fail or had put less money, they actually performed, right? And those who were not who were the most exciting actually failed. It's I can say to this, it's probably eventually really about the persistence and resilience of the team, right? Because even if if the startup is not looking from a very beginning the best way, eventually it's so much about the team. And I heard a lot from the investors that they in VC funds as well, right? That
Mhm.
on the early stage, it's a lot about the team and if the team can execute. But I totally agree that it's very hard to judge, especially if you don't know people well.
Yeah.
So from a one conversation, you would not understand well probably this resilience and actually how actually they deal with the problems. That's why you should rely on numbers in that case. And another point is I'm huge actually a believer and fan of the syndicate investing. Because I had a lot of talks to single investors who invested
Mhm.
directly, and they had quite bad experience of investing, especially in the beginning, as they've been learning. And
Yep.
while you learn, so you actually make bad decisions about what is good or what is a bad startup. And probably the same actually goes also to crowdfunding. If you decide to go for crowdfunding and invest, so the same judgment. You follow the excitement, but not enough numbers and some kind of the investment strategy. So that's why I like actually when I see this grouped club syndicate investing, right? Because then it's this kind of the collective intelligence that come together to have more diverse opinion why this startup gonna fail or why this startup gonna succeed, but also the due diligence is important part, because in a syndicate you actually have the syndicate lead who already have more experience,
Yep.
and this is super important. So if there is like people who are watching us and considering to start investing in the startups, so where to start? What would be your recommendations for them?
Join Toloka. That's the easiest, Toloka.vc, and you join it. But partly joking, of course, the most important part is to learn. I think the dangerous, everybody knows about Dunning-Kruger effect, right? The people who are the least knowledgeable think they're the most knowledgeable. There's an old American joke. There are people who know how to run the world, the companies, and the countries. Unfortunately, they're too busy driving taxis and cutting hair. So the barbers and the taxi drivers know everything. They know everything about economy. They know everything about politics, the wars. They could resolve everything. They're just too busy. They're driving taxis. Otherwise, that would solve everything. So unfortunately, that's Dunning-Kruger effect. The less you know about something, the more you are certain on average that you know everything. That is super simple, but it's not super simple. I've been at it for 15 years as a venture and angel investor. I made more than 200 investments. And the more I learn, the more I understand how complex logarithmic equations all of this stuff is. It's not 2x2. It's not even 2 plus b equals something. Figure out what b is. It's a huge logarithm with a whole bunch of unknowns, that you will never know. How strong is the product? How good is the team? Like you mentioned, team's resilience. I agree with you, but you can only know it looking back at the team, because unfortunately, and those of you who are in human resources, HR, they know this effect very well. Very, very often, more often than not, people who are very mediocre are very good at selling themselves. It's their one skill, to sell themselves. I'm energetic, I'm resilient, I'm charming, I'm wonderful, I'm so psyched, I'm going to do this stuff. But that's all they can do. They can sell themselves, and they don't really know how to do their job. And very often, people who are really great at their job, and I saw it among the founders, are these, quiet, not low energy, but like average energy people who, after meeting with whom you don't go, wow, what an incredible person. And very, very often, and this is, by the way, the kind of type that I would be looking for, very often the real warriors, the real winners in the startups are people who are not bursting with energy, people who are not talking fast and throwing stuff at you, people who are not quote unquote brilliant and whom you perceive as like, wow, this is the next Mark Zuckerberg or Sergey Brin, etc., or other names, but people who just sound totally sane, people who are confident in what they're doing, people who operate with numbers, not words, people who give you very straightforward answers, and people who day after day after day, you're right about resilience, are just working hard. These are the people who win. The people who are not sprinters, not people who are running, 100 yards, but people who are running long, long marathons. And long marathons often do not require that much excitement. They require hard work. They require following up on emails, checking up on business processes, making extra calls and sending extra emails to make sure that your distributors, your employees, etc., did what they were supposed to do, etc., etc. So really, I fully agree with you on the resilience. The problem, though, is that even the smartest investors can never tell, who will be a successful startup, who will be a successful team. And very often, and that includes me, we look at founders and we say, wow, they're so exciting, they're so great. But then it turns out all they could produce is excitement, and they're really, really bad at operations. They're really bad at doing this stuff. And you meet somebody and say, wow, he's or she is a great salesperson, wonderful salesperson. But it turns out that the only thing they know how to sell is themselves. And after they raise your money, they're saying, things are great. We're working on the product. And a year later, you're saying, what's happening? They're saying, oh, the product. We're just like working on the product. And you're saying, what's happening with sales? That's the most important thing about the startup. Oh, sales are doing fine. Don't worry. But you haven't sent the numbers for a few months. Oh, because everything is fine. Send the numbers. You don't need the numbers. Yes, I do. And then you see the numbers and it's horrible. Nothing is growing. There's no growth. The startup will run out of money in 6 months. You guys are going to run out of money in 6 months. No, we're talking with these investors. Everything will be fine. And then 6 months from there, like, yeah, we ran out of money. Sorry, we're closing doors. You lost your investment. So that's what's happening. I think looking back, all of us human beings, we rationalize our irrational decisions. And also looking back, we very often say, oh, I saw it back when she said this and that. I saw it. But you didn't do something, or rather you did something which you should have not done. And my point is that very often, unfortunately, investors cannot tell if the team will be resilient, will be successful or not. We can only tell it looking back and say, oh yeah, I remember when she said that. That was a good signal. I should have known.
Yeah, that's also probably the reason why VC funds and experienced investors like so much to invest in second-time founders, because then
although sometimes that doesn't work too. I invested several times in second-time founders when that was a big. Sorry to interrupt you, Ulyana. That was a big argument, but they were successful, and yet they were not successful. But I agree. On in general, it works. Yes.
I have actually the thought, which is probably more like from my experience, right? That some founders, they become successful too fast, right? And that's why like they didn't have enough time to learn from these initial mistakes. So when they try to build another business and they run to those mistakes, they actually never experience them, right?
Absolutely.
So probably why, like, if the second time founder was bootstrapping a little bit in their first business, or had some pivots, maybe some situations that they handled already, it would positively actually impact the second business. Yeah, but it's super interesting, like what you said, really about the energy, about the perception, and how in reality it may work out. So I think it's actually the part which probably going to inspire here the founders who happen to listen us, right? Because they might think that, oh, I'm not energetic enough, I'm not selling myself enough. Because definitely there are such founders who experience this kind of the situations that they cannot be the brilliant one, right? But still be able to do their work, to execute, and what is most important, to move their business forward. And definitely the good learning for the investors who are listening to us, how to look into the startups and what the risks to take into account. So I really thank you for these conversations. It was super interesting for me, and I learned a lot. I hope that our audience did learn as well. And I'm looking forward to continue working together. It's a great pleasure. And
It is.
thank you for being with me today on that podcast.
Ulyana, thank you so much for wonderful questions. I think they're very important for everybody. All I could say is we're very happy clients of Quorum, and I recommend you to everybody. And in fact, we did recommend you to other companies. And you're doing a wonderful job, and I very much enjoyed the interview.
Yeah, thanks, Igor. Thanks a lot.